We're going to be answering the most commonly asked questions on Roth conversions. And especially as we are at the cusp and at the finish line for tax season, certainly conversations surrounding the tax picture and how to be more tax efficient throughout the next fiscal year is certainly a key topic coming up for a lot of you. And so today we're going to be walking through how to model Roth conversions in RightCapital, of course, what that looks like, and some of the key questions that can pop up when we're looking at modeling Roth conversions, as there's a couple different ways we can do so in the system. And we're also going to look at that big question that might be popping up currently, which is looking at comparing different tax efficient withdrawal sequences for a client plan and what that looks like. And also, of course, the stemming key comparison visualizations that will be there to assist as that visual backdrop that you will have for your conversations to help connect the dots, especially as we're talking about the difference between the different tax buckets that are applicable for each tax account. We're going to walk through some of those key visuals that you can leverage in your conversations. And a key question that certainly pops up, especially if we're looking at evaluating Roth conversions with somebody that is closer to retirement and is closer to Medicare premium age or currently in Medicare filing age, is that question surrounding how is this going to impact my Medicare premiums? And we're going to walk through what that looks like in RightCapital and how we can answer those questions. And as always with RightCapital, there are a lot of different resources that you can leverage. We're going to walk through how you can also leverage those in your practice. One of those resources being that you do have the option to utilize the questions menu drop down and go to webinar to type out your questions from there, and I'm more than happy to answer any questions you might have. Those are going to be answered more towards the end of the webinar, but feel free to type out your questions during, and we'll get to those towards the end. But to start off and to shift gears into RightCapital, today we are going to be looking at the Roth-Geller family plan. But before we take a deeper dive into looking at a proposal of Roth conversions, it's important to understand what the current plan looks like and the current picture looks like for the Roth-Geller family. So if we go to the profile section and into blueprint, here we'll see that key visual summary of what their current path looks like, starting with the net worth, where we can see who owns what. They do have a net worth of $2 million. They're in their early 50s, and they do have a child that is about to enter college. And as we can see, they have a lot of assets stored away in the tax deferred accounts, and they have a decently sized savings stored away individually. For their goals across their lifetime, they do have some vacations coming up. Like I said, they've got that college goal, and they do plan on retiring at 67 and 70 respectively, where we also have those annual retirement healthcare costs kicking on at that point in time, and of course our long-term care cost picture stepping in at the finale. And looking at their current income, savings, and expenses, they are pretty avid savers into traditional 401ks, and they have some decently sized income coming in and decent expenditure as well. So just to paint that picture of what the current plan looks like before we dive into analyzing Roth conversions, important to know what their path looks like and how much they have currently stored away. A key thing when we're trying to paint the picture, and especially if we're trying to have that discussion about the different types of taxable, tax deferred, and tax-free buckets that are applicable, especially in conversations about Roth conversions, is this really helpful graphic that can be found in the investment module and under tax allocation. Here we will see a summary of the client's current tax allocation based off of the profile net worth and what we were just viewing in the blueprint as well. Here we can see how much they currently have in the taxable bucket, in the tax deferred bucket, and also tax-free. A key thing that can make this even more helpful for that discussion of what is the tax deferred or tax-free question, especially if that's coming up, is that you can click into any of these pie chart makeups, like the tax deferred, for example, and when we do so, we will see exactly which accounts are going to be considered the tax deferred accounts, which for them, they just have 401ks, but we can also see what type of accounts still fall under those categories. For them, it's 100% 401k, as we can see from here, but we'd also see that the traditional IRAs pension non-qualified and inherited traditional IRAs are also going to fall under that bucket. And we can also see that with a taxable account, what is currently considered the taxable accounts. So it's going to be very helpful to paint that picture of the differences between those main three types of tax preferential treatment for those accounts. As you can see, they have nothing in tax-free yet, but that's going to be where we're going to be looking at evaluating Roth conversions and putting money into the tax-free bucket. A key thing to consider before we dive into the proposal aspect is also what the current path looks like in terms of our current tax-efficient withdrawal sequence path that we have selected for the client. If we navigate to the gear icon in the upper right-hand corner and into settings and under methodology, this is where you set the foundations for assumptions for the client plan. And especially as we're having conversations about which tax-efficient withdrawal sequence makes sense for a client plan, it's important for you to be able to customize and indicate what the current plans and the current path's tax-efficient withdrawal sequence is. And that can be done via the gear icon settings methodology tab. And here, the secondary option on the left-hand side is our withdrawal sequence. And this is where you can specify what we want to use for the withdrawal sequence for the foundations of the plan. The withdrawal sequence itself is going to be what order would we be pulling from their assets to fund any negative net flows. So in a specific year of the cash flows, for example, if they don't have enough income inflows to cover the outflows that are specified for that year, the system will automatically pull from their assets to fund those outflows. This withdrawal sequence selection right here is where we indicate which order we'd be pulling from the account type buckets. Currently, for this plan, we do have the taxable and then tax deferred and then tax-free accounts selected for the withdrawal sequence. What that means is that if we run out of taxable assets to fund outflows, we then tap into tax deferred assets and then tax-free if all else was depleted. But from this drop-down, you do have the option to indicate that we actually want to pull pro rata across all accounts. This means we'd be pulling proportionally across all account types to fund a negative net flow in the event that we have a negative net flow. We can also indicate that they would be pulling from the taxable assets first. Then when those gets depleted, we pull from the tax-free assets and then tax deferred. Or we can indicate that we want to pull from taxable assets first, then proportionally across the remaining two types of buckets, which is tax deferred and tax free. And then finally, we can indicate that they'd be pulling first from the tax deferred assets to fund outflows, then taxable accounts, and then tax free if all else is depleted. And this is where you can set that key assumption to make sure that we're in line with what the reality of the client's plan is, especially as we're going to be looking at in a second, comparing different tax efficient withdrawal sequences. But this is where we can start to navigate to paint the picture of what the current path is. Within RightCapital, we do have a module dedicated to modeling and analyzing Roth conversions and tax efficient withdrawal sequences. And that's going to be found under our tax tab. Under the tax tab, we're going to see a lot of tax focused aspects within RightCapital, but the distributions and conversions module is going to be found by clicking on the distributions tab itself. Here under distributions, this is where we're going to see and be greeted with a chart visualization of the ordinary income tax brackets across the client's lifetime. For their lifetime, we can hover over any of these years to see exactly how much their adjusted taxable income is per year, and also the thresholds for each tax bracket. And we can see this visualization of where they fall into each. We can also use these icons to include additional brackets for this visualization. As you can see, the 35% tax bracket, for example, is going to be a little bit too high if we want to focus a little bit more on the more applicable tax brackets. We can deselect it and it'll be removed from the chart as we start to continue our conversations. As we can see, there are a couple different tax brackets applicable. There's the 10% tax bracket, the 12-15% tax bracket. And as we look at filling up tax brackets with Roth conversions, it's important to note that we are considering the 2026 TCJA sunset tax law. So what that means is currently we're looking at the 12%, 22, 24, and 32% tax brackets, but that when TCJA sunsets, we'd then be going to the 15%, 25%, and 28% and 33% tax brackets. So within this plan, we are considering that this is going to be sunsetting, but you do have the option to control what you're using for your tax assumptions by once again going to the gear icon settings page. And under tax assumptions, this is where you can control what you want to run with for your tax law. So like I said, right now we're using the assumption that TCJA will be sunsetting. So we'll be reverting to the pre-2017 tax brackets. But you do have the option to indicate a different tax law, such as assuming that we are going to have TCJA, but it's not going to sunset. Or if we wanted to immediately convert to 2017 tax law and change that conversation altogether. So this can be where you set the standard for what you want to consider for tax law, but the system currently with my selection is going to be considering the TCJA sunset is going to be occurring, and that's all going to be a conversation baked into this distribution and conversion module. But as we want to lead that discussion of looking at the tax picture and what's going to be happening for the next couple decades of the client's life, that is when we're going to look and navigate towards the action items. And here on the action items, there are three main things that we can adjust. The first one being we can compare and contrast different tax efficient withdrawal strategies and see how that impacts their ending assets. And so right now in my current plan, I do have taxable, tax deferred, and tax free currently selected. And so I'm going to leave that selected on the right hand side, but you do have the option to analyze and compare to a different tax efficient withdrawal sequence strategy. So for example, if I wanted to see how it would impact their plan, if we chose to pull proportionally across all accounts, I can select pro rata from that dropdown. And now we can see how much more in tax adjusted ending portfolio value we'd have if we followed this route rather than what we have currently. And we can continue to do that until we can see the differences. Some of them might not make a difference, but this is a way to evaluate one of those conversations about which path might be making more sense for a client. And this is only going to be isolating the withdrawal sequence comparison because this is the only thing we have proposed as different. And so we can see that impact right here, but there's also a key comparison visualization that we can analyze under comparisons, where we can also see how much they'd have in taxable, tax deferred, or tax-free assets if we follow this route. Right now, this is only focusing on our withdrawal sequence strategy comparison. And so let's say we wanted to analyze the difference between the pro rata strategy. We can see that impact from here. And if we click on this drop down, there are a couple different visualizations that we can analyze, such as the withdrawals from accounts. So from withdrawals from accounts, we can see that difference between our two strategies. We can hover over each year to see that difference as well, number-wise. And that's how we can really isolate that particular conversation. But as we want to start to analyze Roth conversions, if we wanted to isolate the impacts of Roth conversions on the plan, that's typically when we want the withdrawal sequence and compare two sequence to be the same. They can certainly be whichever path is most relevant for the client and whatever we have selected. In this case, it's going to be the taxable, tax deferred, and tax free for both. This way we can compare the situation of us doing Roth conversions versus no Roth conversions. To start to analyze the impacts of Roth conversions, that's when we'd navigate to number 2 within the action items. And this can be helpful for when we have the conversation with the client. And if they are comfortable filling up a tax bracket and paying those taxes up to, let's say, the 32-33% tax bracket, that's when we can use the slider to toggle to that particular bracket. Once we do so, we'll see that impact of how much more they're going to have in tax adjusted ending wealth if they follow this strategy versus not. But this particular module is going to be focusing on the idea of filling up the tax brackets via Roth conversions. We are going to look at the option to model what we call manual Roth conversions for specific amounts later on, but this module can be helpful for that conversation or just to see if we fill up the tax brackets, how will that impact the plan? And so this is going to be isolating the ordinary income tax brackets and this particular value right here, but you do have a couple different chart graphics that you can utilize via this dropdown. So if we click on the ordinary income tax bracket dropdown, you can also look at the key tax components of the plan and see what is the key factors here. As you can imagine, while they're still working, the salary is a key factor for their beginning couple decades of adjusted taxable income. Same thing with investment income, it's pretty steady. We can see this taxable Social Security picking up when they file, of course, and we can see the impacts of withdrawing from the tax deferred assets and any taxable pensions and annuity as relevant. For them, they don't have any, so we're not going to see anything there. From this dropdown, we can also view the capital gains tax bracket chart, and we can see the difference between our taxable income with the conversion in the green and the taxable income without the conversion in the blue color. And we can see those difference and where they fall into each of the capital gains tax brackets. And we can also view the Medicare premium tax bracket visualization as well. And we can see over time what's happening. Of course, as we turn 65, that's when Medicare premiums become the most relevant, if applicable, for the client plan. But let's isolate the ordinary income tax brackets. And a key comparison visualization, if we go back into comparisons, this is where we can see that key visualization of how much more are we going to have tax-free. We can see we're 97% tax-free if we perform Roth conversions versus our no Roth conversion situation where we have nothing in tax-free. And especially if one of the key concerns is what the heirs are inheriting, we can see how much they would be having in that tax-free bucket. If we click on the drop-down, we can view those withdrawals from accounts in that comparison once again. But we can also see the difference in account balances over time. We can also view the difference, and this is a key question, probably number 3 if we're talking about Roth conversions, is what is the impact to my required minimum distributions? If we pursue the Roth conversions, as we can imagine, we're converting everything in this situation by filling up these tax brackets to the 32, 33%. So there are no RMDs with this particular path versus no Roth conversions. And of course, the secondary question with Roth conversions is going to be, what am I paying in taxes? Here under federal taxes paid, this is going to be looking at the federal level of taxation, and we can see how much we're paying for our Roth conversion strategy versus no Roth conversions, and the difference between each year. We can highlight each year, and we are paying more upfront with these Roth conversions, but looks like less over time. This is how we can see some of these key comparison graphics that isolate some of those key questions that can be asked in terms of what am I paying in RMDs, what's the difference in taxes paid, and what are we pulling from accounts. Going into the details tab, this is where we can see some more granular level detail regarding our Roth conversions. This is where we can see each calendar year and the ages of the clients and how much dollar-wise we are converting to fill up the tax bracket to the 32, 33%. As you can see, we're converting immediately. We have that happening for the next couple decades. And there's no conversions happening after age 69 for the clients. We can also see in the remaining columns what withdrawals are coming from the taxable, tax deferred, and tax-free accounts, and also the account balances for each bucket over time as well. This is going to be considering all withdrawals, including if we have a negative net flow and need to pull from assets, anything along those lines, and even RMDs down the line we'll see over here, and those differences over time. If we click on this drop down, you can also view the tax level details and the difference in adjusted taxable income and total federal tax paid over time. And this can be that different preview of the impact to their tax picture. One thing that is key here is that you do have the option to download this, an Excel file, by clicking on this download button and this blue icon right here. And this will download these three spreadsheet into a spreadsheet format for your ease. So if you wanted to see a different level of reporting, you can always download that into Excel if needed. And then of course, we also have, if you click on the drop down, the opportunity to look at the impacts to Medicare premiums. It's important to note that with RightCapital, we do consider the impacts to Medicare premiums and the 2-year look back that is applicable when calculating Medicare premiums. And we're also going to be considering any income related monthly adjustment amounts that would be happening or triggered by going and converting into higher tax brackets and how that can impact their Medicare premium and any adjustments that need to be made. Here we can view their MAGI over time, the Medicare premium threshold, and the Medicare premiums for each individual client. As we can see though, there are no Medicare premiums for Roth Geller. One key thing if we're trying to analyze the impacts to Medicare premiums, this is going to be contingent upon one of our data entry points back in profile. If we just click back in a profile and go into goals, this is where we will find our annual retirement healthcare cost card. And if we click into this card, this is where we activate and indicate that we want to calculate Medicare premiums for the client or co-client or both. So right now with Roth's retirement healthcare costs, we are using the national average, which means that we're using the national average for retirement healthcare costs, but it's not going to be a calculation of Medicare premiums specific to Roth and their MAGI. If we wanted to turn on Medicare premium calculations, we would do so by clicking on the cost estimate dropdown, and we can select detailed estimate from here. When we select detailed estimate, we'll see 4 fields populate. The first field is going to be relevant for pre-Medicare costs, and this is only relevant to this case if we have this cost starting prior to the client's age 65. So if this cost was starting prior to Roth turning 65, in that case, we would be using this pre-Medicare cost for that year until they turn 65. Once they turn 65, Medicare premiums Part B and D would automatically kick on and be calculated based off of AGI. You do have the option with Medicare Part D, if they are in the circumstance in which they have elected not to enroll in Medicare Part D, to select and indicate that they're actually not enrolled in Medicare Part D from this dropdown. Then we'd only be calculating Medicare Part B for Roth Geller. In this case, we're going to assume that it is both for them. And there's also a field, a fourth and final field, to indicate any out-of-pocket costs. This field would be an additional cost on top of the Medicare premiums. And this is typically something like dental or vision or just outside coverage to fill in the gaps between what they're currently paying for other Medicare premiums. But this is going to be a cost on top of the Medicare premiums Part B and D on an annual basis. So it's important to know if we're trying to really isolate and see the impacts on Medicare premiums and how Roth conversions might impact it, to make sure that we have detailed estimate in particular selected and indicated these parameters as needed. So let's hit save and let's go back to our tax distributions module. And under distributions, now we can have a more isolated conversation, and under details, we'll now see when we scroll further down that the Medicare premiums for Roth Geller and Rachel Geller are in fact being calculated for each of them individually. And so that's how we can kind of fine tune it as needed and make sure we're accurately capturing that picture as is relevant for the conversation with the client and their current path. And this is how you can utilize Roth conversions in particular by filling up the tax brackets. But there are other ways that we can calculate and fill up the tax brackets or look at calculating Roth conversions. And that can be done by clicking on the conversions target dropdown. And from here, you also have the option to change our conversion target. So right now we were targeting the ordinary income tax brackets and filling it up to the 33%, but we also have the option to look at filling up the capital gains tax brackets. And we can use the slider to fill up to the 15%, Let's also change this chart to give us a little bit of a better picture here to show us filling it up as is we can with the current assets that we have. And we can see how much more we'd have in tax adjusted ending wealth if we followed this path. And you can also, clicking on the conversion target dropdown, look at the Medicare premium tax brackets and see how much we can convert without triggering IRMA. So if we're mainly concerned about not triggering IRMA, we can use this slider to indicate no IRMA, and we can see how much we can convert without triggering that particular event and impact to their Medicare premiums. From there, we can then go to details, and let's change this drop down to look at withdrawals and conversions, and we can see how much they're converting and when. And especially as we're having our conversations with the client, there are, of course, those times where as we're looking at these different ways to fill up the tax brackets, that maybe Roth conversions might be going to an age at which they're not comfortable doing Roth conversions. You do have the option to indicate and control the timing at which the system would be calculating Roth conversions via this tool. To do so, we can click on the edit button right here, and this will open up a screen in which we can indicate that we want to specify when conversions should start and also specify when conversions should end. So let's say we had the conversation with the client. They're comfortable doing Roth conversions up until age 80 for Roth. So what we can do is we can specify that by clicking on Roth's age, specifying 80 and hitting save. And we can see if that would have any impact in particular to their plan. But it's just a way to also capture the needs of the clients, and especially if they're comfortable filling up the tax brackets up to the specified percent of 33%, you can also control when we want it to end or when we want it to start. And once again, we see some powerful visualizations under comparisons for this strategy. But the third and final piece that we can change under action items is going to be our estimated terminal tax rate. This is only going to be applicable in this particular conversation and in these visualizations under the distribution module. But this is going to be the terminal tax rate that's applied when heirs inherit these assets. So especially if we're having the conversation and the clients are concerned about what their heirs are inheriting, and that's one of the key concerns for them, especially for the Gellers. They do have a child and they're worried about what their heirs are going to be inheriting and the tax burden that might be left to them when they pass away. That's where this estimated terminal tax rate can come into play. Right now we have it at the default, which is just 15%, but we can use this slider to indicate a higher percentage. And let's say, for example, their child is currently a business owner. They have very high taxable tax rates. We can use this to change this to 30. And when we do so, we'll see an impact to the ending portfolio value displayed here. This is going to be applying that terminal tax rate to the applicable and the tax applicable assets. With them having most of the accounts in tax-free via the Roth conversion strategy, this is not going to have too much of an impact for this particular strategy. But as we can imagine, with the non-Roth conversion strategy, they have the majority of their assets exposed to the tax burden that an heir would be subject to when they inherit these assets. So this is how we can see that visceral reaction of what it looks like if we change the estimated terminal tax rate and how that can impact what heirs would inherit when we pass away. So that's going to be another key feature to the distribution and conversion module in this conversation located here. And as we're having these discussions, and if we like and want to implement these particular Roth conversion strategies, that is when we can navigate to our retirement module, which is where we'll be brought to our analysis tab, and we'll be greeted with our probability success and our proposed plans versus our current plan. One thing to note as we're navigating these conversations is that this probability success is going to be looking at the Monte Carlo simulations, which are the 1,000 trials of market volatility, and it's the percentage of those trials that make it to the end of plan without running out of money. This green bar chart that we're going to see right here is going to be referencing the benchmarker trial, which is the median trial from those 1,000 trials, and it's the median trials ending asset value when they pass away. And so if we wanted to incorporate what we just curated for our distribution and conversion proposal, we do have the option to do so and see how it impacts things like their conversation on their proposed plan by going into the action items where we can start to fine tune and curate our proposal. On to the right-hand side is where we'll find our strategies, including the strategy that we just curated back under distribution. So if we go to the distribution strategy and click on this drop-down, we can change this from current strategy to distribution proposal. And once we hit the refresh button, we can see how that would impact their probability success and how that would impact their median trials ending asset value in this green bar chart. So as you can see, they have a current plan with a 99% probability success. So it's fairly doing well on its own. But with Roth conversions, we have increased that probability success by 1% to 100%. And this is how we can see that side-by-side comparison of one of the first gauges of financial well-being. But there are some other gauges of financial well-being, and that's going to be found under the comparisons in the final 3 subtabs. But particularly focusing on the comparisons subtab, this is going to be looking at a different projection type than what we were looking at under probability. It's important to note the foundations of the comparisons tab is going to be looking at the cash flows in particular. The cash flows themselves are running a straight line projection, which is a guaranteed return, and it's not factoring in volatility to the baseline. You do have the option to apply different scenarios and sequences of return, but we're just going to be isolating the baseline for now. But under comparisons, this is where we can see the comparison between our Roth conversion strategy that we just applied versus the current plan. And we can see here how much more we'd have in invested assets with the Roth conversion situation. And if we click on this drop down, we can also view the comparisons between our net worth if we pursued this route. And of course, that key question when we're talking about Roth conversions is the impact to our taxes. And so we can also click on this drop down to view the difference in taxes paid over time. As we can imagine, we're paying more upfront because we're filling up the tax brackets quicker. So we have higher taxes in the beginning years, but over time, we do have less taxes paid than the current plan, which does not feature Roth conversions. We can also view from this drop-down the difference in assets at retirement. There's a lot of great helpful visual backdrops that can be leveraged found within the comparisons tab here, but also under the Roth conversion module. And that's how you can apply and incorporate whatever we have curated back under tax distributions. And that would include if we had selected a different withdrawal sequence. So right now we did incorporate this in our proposed plan, but that's only going to be looking at the Roth conversions that we have indicated and filling up the tax bracket. But I want to note that even if we specified, and maybe we wanted to also change our withdrawal sequence to pro rata, if we have this selected, that's now going to be translated back to our Roth conversions proposed plan under retirement analysis because we have the distribution proposal selected. So even if we're just trying to isolate the impacts and incorporate a different withdrawal sequence in the proposed plans, you do have that option, even if you don't want to look at Roth conversions. So you don't need to do Roth conversions, and you can do either or both. But that will all be baked into our Roth conversions plan. And that's how you can use the tool that can be that fill up analysis of calculating how much can we convert to fill up those tax brackets. But there is another way to model Roth conversions in their plan. And that's going to be what I was kind of hinting at earlier, which is what we call the manual Roth conversions. And so especially if we're looking at the idea of them filling up the tax brackets, but maybe they're not comfortable filling up so much so often, or maybe we have a specific dollar amount in mind to do Roth conversions, that is when we can go to our action items, still under retirement analysis, and click on the edit button. From the edit button, to add a new path, we would select the add new items button. From here, we then go to income and then distributions. This card is a very versatile tool that can illustrate distributions coming from our accounts in a couple different ways. But let's say in this example, we are looking at modeling Roth conversions. So let's title this card for our ease. Let's title this our Roth Conversions. Right now, we can specify an annual dollar amount for Roth Conversions. So maybe in this circumstance, we're comfortable doing Roth conversions of $35,000 a year. We can enter this into the annual dollar amount field. And you can also indicate who the owner is, whether it's Roth Geller or Rachel Geller, and also from which account. For this situation, it is the 401k traditional account, so we're going to keep that selected. And you can also specify the time frame for the start year and also when we want this to end. Let's say, for example, we want this to end a calendar year. We can keep this selected, but you also have the option, if we click on the end year dropdown, to specify that you want this to end after a number of years, their specific ages, their retirement, or other life events. And let's say in this case, we do want this to stop after a number of years. We can select that option from the dropdown and enter 15 years. And also we can enter any annual increase as applicable. But let's say it's going to be stagnant, so let's leave this at 0. And the key thing with this card to model Roth conversions is going to be selecting what type of distribution we want to do. So right now we have normal distribution selected, which is the default. But since we're modeling Roth conversions, we're going to select convert to Roth IRA. And you also have the option to control the taxation of this particular distribution. Right now we're using the standard rule for taxation, and that's just going to be applying any applicable tax rules and laws when we do Roth conversions for this client, whether or not they're 59.5, anything along those lines. But you can also indicate from here if there is any applicable tax-free, if they're in that unique circumstance where they're going to be in a tax-free situation for these Roth conversions. That is great. Then we can select tax-free from that drop-down. In this case, we're going to be assuming that they're following the standard rule, so we're going to keep that selected and hit save. But that's how you can model one of the ways to model manual Roth conversions. We can see that impact, and you can also see those same graphics in terms of comparisons and the impacts of invested assets and also taxation over time. But that's how you can model specific dollar amounts. We can click back on the header of this income card for Roth conversions, and this will open up the fields where we can start to specify and make changes to this card. If we click on the approach dropdown from fixed dollar amount, you also have the option to indicate that you want to do Roth conversions based off of a percentage of the start year account balance or a percentage of the annual account balance each year. So you can make those changes from here, but you also have the option to indicate that you want to deplete over a number of years their account via Roth conversions. So if we wanted to fully convert an account, we can change our approach and hit save. And now we can start to specify and propose different distribution years. So let's say we wanted to fully deplete Roth Geller's 401k account and convert it into Roth conversions, of course. We can specify 15 and see how that will impact their plan, ranging from taxes to invested assets, and also the impacts to the probability gauge. And that's going to be how we can model those manual Roth conversions and fully control timing, how much we're converting, if we wanted to fully convert an account over a series of years, if we wanted to convert a percentage of the account over time. And for specific client or co-client, that's when we can leverage that particular distribution card to illustrate that and to get more granular. But as we have covered, there's a couple different ways to model Roth conversions. And I already see this as a question, so I'm gonna also note that you can incorporate those distributions and Roth conversions within the current plan. So if that's a path that they're already taking and we wanted that to be baked into their plan, this can also be added by going into Profile Income, and under Add Income, we can add that distribution card, and it's going to be the same exact parameters that you can enter back under the proposal. So if that's relevant, if the client's currently planning on doing those Roth conversions, maybe we have successfully made them do those Roth conversions, and that's the conversation that's happening, and we want to make sure that's part of the current plan, you can certainly do so with the distribution cards. But before we start to dive into the conversations of the resources, a key thing is curating PDF reports of this information So if we go to the gear icon report section, you do have the option to include the tax distributions module in the PDF report. So especially if that's what we're going to be using for Roth conversions, you can incorporate those, but you can also incorporate the retirement analysis. And a key thing here is that under analysis, the same thing for cash flows, that you can click into each of these to see additional functionality and specify exactly what you want to include in the PDF report. So you can get very granular in terms of what subtabs you want to include or exclude from this PDF report, but you can also select which plans you want to incorporate. So especially if you have multiple proposals going, you can select those proposals from here and also the current plan or whichever one you want to incorporate and hit done. The same thing for cash flows, and can download that and PDF report as well.